Today, we're diving into a financial strategy that pretty much flips conventional wisdom on its head. We're going to look at life insurance not just as, a safety net, but as a surprisingly powerful tool for building wealth. All right, let's just jump right in with the question. Imagine you're buying life insurance with the exact same death benefit, say $1 million. Would you rather pay $500 a year for it or $10,000 a year? I know, it sounds like a no-brainer. Why would anyone pay 20 times more for the same thing? Well, stick with me because the answer to that question is what this is all about. So let's start with that first option, the one that seems so obvious, paying less. This leads us right into what our source material calls the myth of cheap insurance, where we're going to see why cheaper doesn't always mean better. That $500 option, that's your classic term insurance. It is super simple, very straightforward. You pay your premium for a set amount of time, a term like 20 or 30 years. If you pass away during that term, your family gets the money. That's it. It does one thing and one thing only. It pays out if you die. Our source points out this really fascinating piece of logic. It says the best day financially to own a term policy is the first day. And think about that for a second. If you paid your first premium, walked out the door, and got hit by a bus, the return on your investment would be, astronomical. But from that moment forward, with every single payment you make, the financial value of that policy actually goes down. And the numbers, wow, the numbers really back this up. A study from Penn State found that a staggering 99% of all term policies never, ever pay a death claim. They either lapse because people just stop paying the premiums, or the term ends and they simply expire. So for almost everybody, all that money paid in premiums, it just vanishes. The return is zero. Okay, so that's the cheap option. But what about that crazy expensive $10,000 option? Well, this is where the story gets really interesting, and it involves a player you probably weren't expecting, the U.S. government. So get this, the federal government actually has laws that limit how much money you're allowed to stuff into a life insurance policy for any given death benefit. Now, that fact alone should make you stop and ask a really, really important question. Why would they do that? I mean, think about it. The government doesn't usually care how much money you save in your bank account. They only step in and set limits when what you're doing gives you a massive advantage. And in this case, that advantage is all about taxes. So the government basically drew a line in the sand with this thing called a modified endowment contract, or a MEC for short. If you fund a policy with too much money too quickly, you cross that line. The second that happens, your policy gets reclassified as a MEC and it loses all of its amazing tax advantages. It starts getting taxed just like a 401k or an IRA. And this creates two totally different worlds for your money. In one world, you have your typical retirement plans and these MECs, and they come with all the usual rules and penalties for taking your money out. But in the other world, as long as your policy stays under that MEC line, it exists in this special, protected space with incredibly favorable and often tax-free ways to get to your cash. The source uses this brilliant analogy for a 401k. It's like you're co-signing on a loan with the government, but you don't know what the interest rate is. They just say, don't worry, we'll tell you the tax rate when we need the money back in 30 years. Who knows what that rate will be? The strategy we're talking about here is designed to avoid that uncertainty completely. So this leads us to the big reveal. What actually happens when you intentionally design a policy to hold as much cash as legally possible, funding it right up to that government red line, but never crossing it? All right, let's do a little thought experiment. If you could wave a magic wand and create the absolute perfect financial account, your dream vehicle for growing money, what would you want it to do? What would be on your wish list? Well, you'd probably want your money to grow without getting hit with taxes every year, right? And you definitely want to pull that money out completely tax-free. You'd want good, competitive returns. You'd want it protected from lawsuits. You'd want to be able to use it as collateral for a loan and get to your money at any age without penalties. Oh, and if you got disabled and couldn't work, it'd be great if the account just kept funding itself for you. Sounds like a fantasy, right? Well, here's the kicker. According to our source, this isn't a fantasy. This is exactly what a properly structured, maximum-funded, permanent life insurance policy is built to do. There's even a name for this strategy, a maximum efficient contract. It's designed to check almost every single box on that dream list. So let's just lay it all out, side by side. You've got your 401k and this maximum efficient contract. Both give you tax-deferred growth. Awesome. But then look at this. Tax-free access? Nope, not with the 401k. Creditor protection? Check. Use it as collateral? Check. Access before 59 and a half without penalties? A huge check. The only thing you give up is that upfront tax deduction on your contributions? So, what this all comes down to is a complete reframing of why you'd even have life insurance in the first place. It's about shifting the conversation away from just covering the bare minimum. Our source makes such a powerful point here. The very thought of need represents the least amount necessary. As soon as you start thinking in terms of what you need, you are, by definition, operating from a mindset of scarcity. You're trying to figure out the absolute minimum to just get by. And that is the fundamental shift in perspective. You stop asking, what's the least amount of money my family needs to survive if I'm gone? And you start asking, what will it take to absolutely guarantee the life I want them to have? It's the difference between planning for adequacy and planning for abundance. And so that really leaves us with one final question for you to think about. When you look at your own financial plan, is it built defensively, just to cover your basic needs? Or is it built offensively, to proactively go out and accomplish everything you truly want? Because based on what we've seen today, the answer to that question could change everything.